Indus Towers. The premise on which they've opened it for Vodafone Idea is that one, the company's 5G launch has taken place in Mumbai. Plus, they will be able to hopefully raise that bank funding, which will further enable their capex and rollout plans. So they're looking at Indus and Vodafone Idea. Back to you.
All right, Rima, thank you very much for that. So Indus and Vodafone Idea on Ambit's kind of watch 10% today. At least 4-5% in the pre-open, Indus as well. Just a couple of seconds and we'll have prices come up. So first rates are going to be lower, 0.6, 0.7% down, 23,385 in the Nifty. The Nifty bank is down about 0.5 odd percent. So in line, I think, largely with what the pre-open, etc. was indicating. Small cap index is down, but down small, just 0.15 lower to begin the day. I think 0.4 now. The mid-cap index will also come up on your screen. Advanced decline, at least straight out of the gates, 1:1, up and down. So equally matched at this point. But it's 120-odd point lower start, which is 0.5%. 23,400 is where we stand at, which is actually not bad, given, the turmoil that we've seen in global markets over the last 2 trading sessions, so as to speak. So the heat map up on your screen, it's more down than up. About 13-14 names are higher and the rest of everything is starting lower at this point in time. Surabhi.
Absolutely. 100 down on the Nifty. Actually, before I get to the Nifty stocks, just because we have such heavy news flow today, let's look at Vodafone Idea and Indus. They are the stocks of the morning. 10% circuit on Voda Idea. Indus is up about 7%, and HAL with that massive order is up about 5% as well. So the news flow stocks are still finding green, despite the fact that it's a bit of a shaky start to begin with. On the Nifty, what is weaker? Actually, large financials and IT, both are down and out. Infosys 2% lower, Tech Mahindra about 1.5% on the lower side, HCL Tech, TCS. All the tech names are weak. There's some weakness in large financials like Shriram Finance, HDFC Bank, Axis Bank is on the lower side. L&T, Reliance, these are big stocks which are all on the red side of the screen, at least as of now. So then what's up or what's fighting for the bulls? Trent is seeing some bargain hunting, 3% up on that stock. ONGC is up about 2% as well. Power Grid, some PSU names, NTPC, Coal India. Actually, PSUs are doing pretty well, must say that. Eicher Motors and Hero, 2 stocks from the auto space. Even Bajaj Auto, actually. The two-wheeler makers are doing well. PSUs are doing well. But IT and financials seem quite weak at the start. Still down about 87 points, but it's better than that 170-point gap down that the pre-open was indicating.
Well, that's right. Good recovery, in fact, in the first few minutes itself from the low. So that initial dip has got bought into. Stocks that are moving around. Punjab and Sind Bank on rather high volumes. That stock is down close to around 15% or thereabouts. Remember, the free float is very, very limited. But that one is down. Punjab and Sind Bank should come up for you on the screen. Bajaj Hindustan Sugar, they're close to default. That's the word that's coming in from Care Ratings. They are warning on that front. They say that it could turn into a non-performing asset, as they had to arrange close to 270 crore rupees by March 31st. So that's the reason why that one's down close to 5% on large volumes. Vadilal Industries, the promoters of the ice cream maker, they have settled the spat between the promoters and they're looking to rejig the firm's management. Because of that, that stock, in fact, is flying away. That's up close to around 10% or thereabouts. Volume's not very, very high, only around 30,000 shares that have got traded. HAL, as you all said, that's flying away. HBL Engineering up 7%. Indus Towers, we were talking about this earlier this morning, that Vodafone Idea could gap up. And probably another way to play this entire theme could be via Indus Towers, because, Vodafone Idea continues. Then, in fact, you'll have a positive rub-off on that one as well. So, fairly okay start to trade. We have come off the low point of the day. The Nifty is 100 points off the day's low. The mid-cap index, that's the one to look at, has underperformed in the last 6 months or so. Pulled back a little bit in March and starting off April with a wee bit of a positive tick. Prashant, looking good?
It's looking good, and the initial dip has been bought into, but this is just the start, so we'll have to see. Just a couple of other names. It's all news, right? HAL, Indus, HBL, all news-related names, right on the top of the volume-led gainers list this morning. Trent is coming up as well, about a 4% gain on Trent, about 5,500 plus. Fortis has been doing well. Last 3 days, it's come up from about 640 levels to about 720. And I think Friday was a big day for Fortis as well. The hospital company Kim's is up 4%. But, beyond that, nothing in terms of volumes. It's a pretty thin day. if you want to look at price action in conjunction with volumes. So yet to pick up in any meaningful capacity. I think Nigel mentioned Voltas, right? Voltas is down 3.5. So 1407, 1408 on Voltas on the other side. And it's coming out with volumes, almost 300,000 shares coming through there. The IT names, Infi, TCS, HCL Tech, they are taking a bit of a knock between 1 and 2.5%. So large cap IT is not doing very well. There is Amber, which is down about 3%. K Fintech is down 4%, a capital market play. Lupin is starting lower. AG's Logistics is down about 2%. I can spot Telecom as well, along with the other three IT names that I mentioned. So that's the lay of the land. We're down about 100 points on the Nifty. 23,420 is where we start. Najib?
Just one word on trend. The reason that the stock is outperforming today, they put a disclosure up that as per their update in Q4, they've operated 248 Westside stores and 757 Zudio stores. And the street has taken that update very, very positively. Why is that? Because for Westside, the store addition is close to around 10. That's in Q4. That follows up the 12 that they added in Q3. Remember, in the first half, there were some net closures. So there is an addition that we're seeing on Westside. And on Zudio, they have net added close to around 120 stores in Q4. This is much higher than various estimates. So because of that, the total number of stores that they're operating is higher on both counts, Westside as well as Zudio. The street likes that, explains why that stock is bursting away up close to around 4%. And a few sessions ago, we highlighted that the stock was doing a relative outperformance. It had protected various, support zones as well. So keep an eye out on that one. For the time being, that's the stock of the morning from the Nifty pack.
Absolutely. It's come off the lows over the last couple of weeks as well. About 4% this morning on decent-sized volumes. Sanjeev Prasad is with us, Managing Director and Co-Head in Kotak Institutional Equity. Sanjeev, good morning. Great to have you back on the program. Prashant here. What has been your assessment of things, Sanjeev, on the recovery that we have seen? Do you think it is sustainable? Underlying in terms of what your interaction and your team's interaction with corporates, companies, are things turning at the margin a little bit? RBI seems to be focused on, doing what it can to revive growth. I don't know if the fiscal thing will happen. Tax cuts, of course, will take effect. But what's your overall sense?
Okay, so I think we're still, I would say, somewhat cautious on the market. We have seen some recovery, but that's more led by the banks, actually. It's not as if the rest of the market has really participated in the recovery. The market is up roughly about 5% in the last month or so. But at the same time, we are also seeing earnings downgrades. So we've seen about 2% earnings downgrades in the last fortnight, more linked to cuts in the consumer sector space, in IT services, and also oil, gas, and consumable fuels on lower oil prices. So as far as the fundamentals are concerned, nothing much has changed. If anything, on the earning numbers, we have seen some downgrades. Coming to the economy and the company's commentary, I see nothing much has changed, I would say, since we last spoke. There's still some talk of rural recovery, but nothing beyond that. Urban is still looking very slow based on the commentary from the companies. If you look at the investment part, still looks really slow. You have seen the numbers for the government for the first 11 months, basically flat on a YOY basis. So no real excitement as far as the capex cycle is concerned from the government side. Housing cycle, we'll have to wait and see. Things have been good for the last 3-4 years, but I think given the big increase in prices in the last year or so, you could possibly see some slowdown. And we are not seeing any real recovery in the private caps part. And we put out a big report on the whole investment cycle and somewhat cautious view over there. So both on the consumption investment side, we're not seeing any real recovery, I would say. So that's where we are. The market is not cheap enough, for us to get terribly excited. Market not super expensive. Also, if I look at the large cap Nifty 50 index, about 21 times, not too bad, I would say. But on an individual basis, it's a struggle to find ideas. Most consumer-related sectors are still fairly expensive. Investment stocks are still expensive, especially in the context of the slowdown that we are seeing in government spending and no recovery on the private capex part. So I would say no real excitement at this point in time.
Got that. Sanjeev, hi. So I just want to understand how you're thinking about financials right now. Relatively, I think large financials is something that you've still liked. But the issue is, I was just looking at the Nifty Financial Services Index. You know, it's already almost back at the all-time high because a lot of money has been going back on the BFSI side. Even the Nifty Bank, I mean, I'm just checking numbers. Let's get these indices up on the screen if we can. The Nifty Bank is also 11.5 to 12% off the lows. And now it's about 5% away from the all-time highs. That's Nifty Bank today. Let's pull up longer-term charts if we can. This index is 5% away from the peak. And the Nifty Financial Services Index is practically back at the all-time high. So, Sanjeev, the question is that then what's really left to play? Because there's still some concern about a pickup in credit offtake and whether growth can come back. Your thoughts?
So if you break down the entire financial services into the banks, NBFCs, and insurance, as far as the banks are concerned, again, you have to break it down between the frontline private banks, the second-tier private banks, and the PSU banks in general. The valuations still seem okay. I mean, if you look at the private banks, the frontline ones, yes, they have gone up. Maybe not much more scope of relating from where we are. If you look at an ICICI Bank adjusted for the value of a non-bank business, it's about 2.5 times. So maybe the scope for relating is limited. But the bank is doing exceedingly well, checking all the boxes, delivering about 15% ROE. So at best, you can hope, for maybe, if not some relating, ROE-linked returns from the stock. And I would think maybe HDFC Bank in a similar boat as of now, given, again, the relating which has happened over there. Look at the tier 2 banks, they had some challenges over there. If you look at an Axis, for example, 1.7 times price to book on a 12-month forward basis, possibly some scope of relating. If some of the concerns which have, arisen for Axis also, unfortunately, as part of whatever we have seen in IndusInd Bank, once hopefully those concerns get addressed, maybe you could see some relating over there. PSU banks still look interesting, still cheap, 0.8 to 0.9 times most of them, barring SBI. And I think they could probably hold up better in this environment, assuming the market is okay. If the market comes off, then all bets are off in that case. But given that they don't have much of exposure to, let's say, the MFI loan book, which has what has plagued some of the small finance banks and MFI and BFCs, and they would probably be better off in the rate cut cycle which we have entered, given the fact that more than slightly 50% of the loan book is MCLR loans, which don't get affected that much. So they may be in a slightly better position compared to the private banks on the NIM part. On the asset quality part, yes, there are still concerns out there. Hopefully next 1 or 2 quarters, if we don't see anything bad coming out on the credit cycle as far as the PSU banks are concerned, maybe there's some scope of relating in the multiples over there. So that's as far as banks are concerned. NBFCs have seen a terrific run linked to the rate cut cycle. Valuation looking reasonably full, I would say. We have been quite positive on the Bajaj, Twin, Shriram, etc. All of them have done quite well. Maybe not much scope for relating, but the companies can deliver quite solid numbers. On the insurance, valuations are still quite attractive. Some of the regulatory / policy-led concerns seem to have finally been addressed. Hopefully, nothing more negative coming over there. And lastly, the capital marketplace, again, they will more depend on what's happening in the market, right? They're entirely exposed to the whims and fancies of the market. Valuations are, high over there, but I guess people are taking a longer-term call despite the short-term blip that you are seeing in trading volumes, etc.
Hi, Sanjeev. So you're sounding fairly cautious, but you're still working with Nifty EPS growth of around 13-14% for the next 2 fiscals. Is there a downside risk even to that?
I would assume so. I think there's some downside risk in autos for sure, given what is happening on the global side, and even domestic demand environment is not looking very good, especially on the four-wheeler side. So possibly you could see some downgrades, and we'll have to anyway wait and see, how this whole tariff issue plays out, how much of the Indian government open to further competition from, imports, etc. And what does it mean for the domestic OEM companies? So that's one risk still out there. I think the margins are still on the higher side over there, and given the run-up in raw material prices, both aluminum and steel off late, you could possibly see some margin pressures. in a weakish demand environment. Otherwise the companies could have been in a position to pass it on, but it will be slightly challenging given the current environment. I think consumer names mostly would probably still see some downgrades. The demand environment is still looking fairly weakish. And lastly, coming to the IT sector, the hopes of recovery keep getting postponed. We have seen some earning downgrades over there. But if things continue the way they are, in the sense that companies themselves not in a position to take too many decisions. And when I say companies, I'm talking about the customers of the IT services companies, given the uncertainty which has been created because of the policies of the Trump administration. A lot of decision making could possibly get postponed. Yeah, so possibly some downgrades there too. Yeah, so 14%. That's what we are working with currently, but I don't rule out 1 to 3% over the next 1 or 2 quarters. This quarter will give you some more sense in terms of how things are looking, what kind of management commentary come. But the earnings are not the problem. The problem is the valuations. You look at on a bottom-up basis, sector by sector, stock by stock. In most cases, valuations are higher than pre-pandemic levels, and that's where I struggle honestly. Given the fact that global interest rates are meaningfully higher compared to pre-pandemic levels, risks have definitely gone up, given geopolitical issues and so on and so forth. And 3, disruption risks across sectors and companies have gone up meaningfully. So to give the same multiples, higher multiples versus pre-pandemic levels for lower growth and far higher uncertainty with respect to cash flows, likely lower profitability, that simply doesn't gel with me.
I know, absolutely. Point taken. Sanjeev, I'm not arguing that maybe if global interest rates come down, as the US administration very clearly wants, the focus is on bringing down interest rates, devaluing the dollar, etc. I mean, it can't be a catalyst or an argument to buy something in terms of stocks. But it is a factor in the overall scheme of things. You said, interest rates are far higher than pre-pandemic levels. At the margin, how much of that is a factor when you look at valuations?
Should be logically, right? Ultimately you're working on some cost of equity, and if your risk-free rate is higher, logically your cost of equity should be higher. But these are all theoretical concepts. People can ignore it, but it's a fact of life, right? Your bond yields are much higher. Your opportunity cost is a lot better. And the bigger issue is, risks are far higher now compared to what they used to be. If you look at any sector, you have a nice, market structure, 2, 3 players, not much of competition. But across sectors, that has changed dramatically now. A lot more competition. So volume growth will, be split across more number of players. And B, profitability could be under pressure. And we are seeing that in several sectors, right? More and more announcements coming from companies to enter that sector. Wherever you're seeing higher levels of profitability or returns, companies are, making plans to enter those sectors. So those high levels of profitability will not sustain. So it is pointless, using the same framework as what we have used in the past. Everything has changed, right? So your risk-free rate is higher. Your risk premium should be higher given far higher levels of disruption and macro risk. So logically, if the cost of equity is higher, multiples should be lower to factor in the extra, risk that one is carrying currently. But yeah, I guess, theoretical argument aside, market has its own way of looking at things. But you are seeing that challenges coming through ultimately, right? You have seen massive derating in multiples of several stocks. You have seen several sectors stock not doing it for the last 2-3 years now. So yeah, so some of these, concerns which we've been highlighting for not today, we have been highlighting these points for the last 3-4 years. They're eventually playing out. More competition is a given now across sectors. That seems to be a norm. Profitability is coming under pressure. Returns are coming under pressure. Now to the market to decide how to treat.
Sanjeev,
yes.
Sanjeev, you have highlighted quite a few concerns, but do you think on the headline index, the downside risk could be limited at least, give and take everything?
Yeah, given the composition of the Nifty 50 index, yeah, the downside may not be 5-7%, I would think. Again, these are assuming normal situation, but we're not living in a normal time, so keep that, risk factor in mind, of course.
All right, Sanjeev, we leave it there. You've published a big anchor report around the CRDMO opportunity in pharmaceuticals, and next time you're on, we'll kind of sort of deep dive into that. But thank you very much for joining us with that perspective on markets. Nigel.
Well, that's right. And as we're having that talk with Sanjeev. Just take a look at the Nifty. We're almost in the green. That's giving you some kind of indication about the mood of the market as of now. Post the big dropping that we saw a pullback in March. And now it appears that the street wants to buy into that dip. So let's see how that pans out. But the first 20 minutes or so have been good. IndusInd Bank, that's the top gainer. That's up close to around 5%. Trent as well as higher. And Bharati Airtel has done a U-turn, started off in the red. That's moved well into the green. A larger weight on the index always helps when that one recovers. But let's get our first corporate on the show. We have Renewables. They have settled dues for its German step-down subsidiary, GmbH. To help us out with what does this mean and how do the books look now, we're joined by Mr. Pradeep Kheruka, the chairman of Renewables. Hi, Mr. Kheruka. Always a pleasure having you on the show, and good to start off the new fiscal with you itself. Now, this appears like a good move done for your subsidiary. Could you tell us the total quantum of the loans that were taken by GmbH? What is the remaining debt post these repayments you've made to HSBC as well as HDFC Bank? Please go ahead, sir.
Good morning. So, thank you. This has reduced the overall debt exposure to the group, and we're down to a little over 300 crores now. Also, the sort of sword which was hanging over the head of GmbH has been removed. So we are the noises coming out from the European Union and from Germany in particular are very positive for domestic production of solar modules and all its components. So it's a matter of time. I think that they will be announcing policies which are going to spur growth of local production, which means good business for our subsidiary. Of course, none of this is yet in hand, and we are waiting patiently and with bated breath, and hopefully we will see good times there. But we don't know when. That is the question.
So the debt has come down to 300 crores, right? That's at the group level, right. For the...
Yes, for the group, at the group level.
Got it. Right. What about the problem has been with regard to the operations? And as you're saying, there are a lot of factors at play. The commentary has been a little bit better in the recent past. But how do you see the subsidiary turnaround? How do you expect the performance to pan out, say, in the first half of this fiscal and in the second half?
You mean the anti-dumping duty, or when you use
the overseas subsidiary? Let's talk about the overseas subsidiary.
Yes.
Yeah, yes.
So last year, the European Union saw installations of 65 gigawatts, which is huge, and there is no question it's visible around the world. Now the people themselves, meaning the markets and businesses, have latched on to renewables in a very big way. We've seen a robust growth in India. We're seeing robust growth in Europe. And now if by the 1st of January, 2026, it is law in the European Union that 30% of all installations must come from products that have been made within the EU, using components which have been made within the EU. So therefore, there is no escape from that. You will not be able to install a module which is imported from anywhere. It has to be made in the EU up to the extent of 30%. So I think that the writing is writ large on the wall, and we would definitely see good times ahead for the German subsidiary based on these indicators.
It was operationally loss-making, right? As of the last count, do you expect it to turn profitable?
It was operationally loss-making. Yes, that's true. The last quarter, we had cooled down the furnace on the 31st of December in order to stop the losses, and there was nobody to buy the glass, so we wouldn't know what to do with the glass once we had made it. So for that, we had large stocks which we have processed and sold in the meantime. So at the moment, it is quite lean, and we are exploring different options. And as soon as we see the sound of a new policy coming out, we are ready to light up the furnace and start. We have the workers in place. Everything is in place. So
when do you see it turning profitable, sir, this particular German subsidiary?
The moment the production starts, it would start at a profit, I would believe.
Okay. All right.
Yeah.
Just before we talk about the overall business, just a final hygiene question out of the way. Apart from this subsidiary, are there any other entities, your subsidiaries, where you have such a standby letter of credit facilities where you might have to make payments apart from this German subsidiary? Okay.
Nothing.
None others. None others. Got that. Now let's talk about the recoveries, what you were earlier alluding to, because we've been speaking so frequently in the last 1 year, right? And finally, that anti-dumping duty, the countervailing duty, all of that protection did come in.
Yeah.
So what has been the impact on ground? Have glass prices started moving higher? What's happening? Because you had guided that maybe Q4 should be much, much better. What's the recovery? And where are we right now?
The recovery is at hand, which means that our selling prices are near the MIP, and we are manufacturing at 100% of our capacity. We are selling everything that we make, so I would say that it is functioning well, and all the portents are good. The demand is very high. There is, I must say, the decision by the government of India to impose ALMM, which has mandated the use of domestic modules for nearly every application here, has been a game changer for the entire industry. So I see module manufacturing rising. We just had the inauguration of a new cell manufacturing facility on Saturday, perhaps India's largest, and people are very buoyant, full of hope. And
so EBITDA break-even, sir? I mean, I'm going by what you said. It's a very important statement that now your prices have at least come back to parity at the MIP level, the minimum import price. So does this mean operations are positive at an EBITDA level now?
Operations are at a decent positive.
Okay.
Yeah. So
right.
we have. So we see all the signals are positive as of now. And we do not see anything on the horizon which might turn it, any other way. So it looks like a good runway going ahead.
Okay. All right. And we look forward to chatting with you and getting further details at the end of the Q4 numbers once you report it. But before we let you go, we have to talk about President Trump, right? He's talking about tariffs. Do you see any indirect impact on your business? Do you have any direct exposure to the United States? If you could fill us in with a few details, because tomorrow is supposed to be Liberation Day as per the way he has termed it. We'll hear about tariffs. The tamasha hopefully comes to an end. But tell us, what is the current exposure you have to the US, and could there be any kind of indirect impact on your business?
The indirect impact, if any, could only be positive. So there is a manufacturing ecosystem in the United States for solar modules. And it's no longer possible to import solar modules in the US from China, because there is the possibility that some of the cells may have come from Xinjiang province, and that is absolutely forbidden. So modules are coming into the US. They are being made in the US. We were one of the sellers of glass for those modules. If there is a stringent duty on imports from China and there is none from India, then we stand to gain. I really don't know where solar glass features in the list of the items which are subject to tariff. So if similar tariffs are imposed on India and China, then we are at par with China. In case they are imposed selectively on China, then we stand to gain. But we have nothing.
Solar glass definitely.
Any downward. I don't see any downtrend anywhere on account of any tariffs in this case.
Yeah. We'll find out. Thankfully, though, solar doesn't get mentioned too much. What gets mentioned is coal and oil and all the other rest of the stuff. Yeah, we'll see. Thank you very much. And I think it's an important point, right? I mean, if China, that's the other second-order impact, which you are very familiar with. And that is what many across industries fear. If China gets tariffed more, they may look elsewhere to sort of, in a way, dump excess capacity out of China across a lot of industries. And I think we've been discussing that as well. So we'll see how we respond to that. So it's a pretty dynamic kind of situation, not just, in your sector, but across the board.
I can say straight away that with a minimum import price in place, there is no question of any impact that any Chinese sort of adventure would have on us. As a matter of fact, the minimum import price has done something very good for the Chinese solar glass industry. I'm told that their prices are up by 20%.
Oh, wow. Wow.
So therefore, that is bringing our MIP has brought a ray of hope for the Chinese.
For the Chinese. All right. Thank you very much, Mr. Kiruka. It's always a pleasure. And we'll speak again once we know the details of this, the tariff business tomorrow. We'll take a quick commercial break here. We have the management of Intellect Design Arena, Arun Jain, with us on the other side. We'll be speaking with them about how the outlook is kind of sort of moved since we last spoke to Mr. Jain at the beginning of the quarter. Stay tuned. Coming up. Okay, welcome back. The markets recovered nicely. We're up about 20 points. And on the Nifty, that is 23,550 on the index. But more importantly, look at the broader market. 4:1 advance to decline ratio. And I think now with 30-40 minutes behind us of trade, it's a good time to look at this. 0.5% on the mid-cap index, and I think the small-cap index perhaps doing a little bit better now. Let's welcome in our next management. Intellect Design is the company that I'm talking about. Stock's been under a bit of pressure this year, along with the rest of the space, down about 25% or so. Now, the management of Intellect Design was expecting Q4 to be a better quarter. I mean, they didn't give out a specific explicit guidance, but, the statement when we spoke with them at the end of the last quarter, beginning of this quarter, did indicate, now I should say it's the 1st of April, the beginning of the last quarter did indicate that it's going to be a healthy one. But have things changed since we last spoke? Project sort of approvals, etc., are they getting elongated? Have conversations turned a little lengthier now before a deal is struck, before orders are handed out? That seems to be the general sense because of all the uncertainty in the world, especially in the US. Mr. Arun Jain is CMD. The company is with us now. Mr. Jain, good morning. Great to have you with us here. Appreciate your time. Prashant here. So that's exactly my question, sir. Do you stand by the broad picture that you painted for us about Q4, which is that it's going to be a good quarter?
Yeah, so since Intellect trading window is closed now, so it's a quarter is closed. Today is the 1st of April, so I cannot comment on it, but it's in the right direction. So that's what I can comment on it. So today, the idea was that so much changes are happening in IT industry, and you wanted to talk about the business prospect of IT industry, which is the impact of AI in IT industry or the way service industry is getting impacted. So that's how we can establish our dialogue on the direction of Intellect in next Intellect 3.0. We are entering into 3.0 now in this financial year. Last 4 years was Intellect 2.0, where we build up disruptive technology, eMAG.ai, which is, and move the focus to Europe and America. That's what I spoke to you last time. And that our Europe and America business should be
fair enough. Yeah. Fair enough. I won't press you on numbers, etc. Completely understand. You said the right direction. But could you talk, because it's so fast-paced changes, right? Could you describe the environment for our viewers?
That's right.
Yeah, go on.
So I'll describe two ways. One is services industry, then product industry, and then AI industry. So all are interlinked. AI industry is bringing significant amount of productivity gain in software engineering processes and services. So definitely service industry will be under pressure unless they closely come to the AI. Intellect as a company, we invested into AI way back 2017. In last 8 years, we built up a platform called Purple Fabric, which I mentioned in separate investor call on 18 December, that this is a platform which has a potential to grow 1,000 crore to 5,000 crore kind of a new revenue from the AI platform. This is the first kind of platform from India, which we call business impact AI. A lot of foundation models are coming on the ground level, but they are not translating into business impact. and a lot of business impact in operations, in sales, in service, in risk and governance, the four major areas which financial institutions are looking at. We build up a complete guide rails and guardrails to drive high acceptance of AI platform, which will be launching in this coming quarter. So that's one point I want to mention, where we are very bullish about what many things in America are not able to do on business impact AI, which our teams are able to do it. And we announced a large deal in February, which is more than 200 crore deal on AI platform. It's on the ground of this platform, not just a product, but on which multiple products can be built. So that's a very, very positive side for us, which is giving us Intellect 3.0 journey of 3.0 to be exciting.
Mr. Jain.
Sorry, Mr. Jain, just one thing. Purple Fabric, what you said, enterprise AI, you said revenue potential could be 1,000 to 5,000 crores.
That's right, in next 5 years.
This is new revenue, or this is revenue which you would have already earned, but it kind of now...
It's a new revenue. It's a completely new revenue.
Okay.
Okay, so that's the AI opportunity, and that's great to hear, Mr. Jain. But I just want to come back to the opening question that Prashant kind of put out to wrap our heads around this. And I know you can't talk specific numbers on Q4. I'm not asking for that. But in general, if we talk about FY26, then the guidance or the indication that a lot of companies have been giving, including yourself, I mean, you were talking about 15% growth earlier, perhaps improvement in margins. Is all that at risk right now because of what's happening in the US?
What are the indications we have in our planning and design of the business of 3.0 to do a double-digit growth or 15% growth is the intact. That's what we want to look at it because of our product nature of business. The EMAC, which is zero-waste architecture, we are giving a significant benefit of choosing Intellect technology with finite thinking and first principle thinking. It's really gelling well in today's circumstances. US, Canada is a good market for us. UK is a good market for us. France is a good market for us. So these are the markets. So our dependence on US alone is not so high. But US, the technology that we built of US in insurance sector is very, very differentiated. Complete AI underwriting workstation is full end-to-end technology, which is gaining momentum in US.
So 15% revenue growth aspiration for FY26, that remains intact, right?
Yeah.
Okay, good to know.
All right. Hi, Mr. Jain. Don't want to push you for a number, but at the end of Q3, you indicated that Q4 will be strong. And the number you indicated was closer to around 700 crores is possible. The last many quarters you have done in the vicinity of around 560 crores to around 620 crores, very, very approximately. So without getting into numbers, that guidance you had given, that stands, right?
Yeah, you're putting in a different word, but I'm under regulatory compliance, so that's the issue. Otherwise, I would have shared.
Okay, all right. But it will be a far more improved performance in Q4 in comparison to the early quarters, correct?
That's right.
Got it. Great. What about decision making? You had spoken about this, that it's got a little bit elongated. From the time, we talk about the pipeline to closure, I think it was taking close to around 12 months or so. You had indicated about this the last time around. Has that improved? Has it got a little bit worse, or is it as bad as it was earlier?
I will not say good or bad. I will say that process of selecting any technology or any product which is going to make significant business impact, and the cycle time because of signatures, regulatory signature, which can go up to 10 signatures to 14 signatures, that's still intact. That doesn't change. But now we understand that we need to build up more pipeline from bottom up to ensure that we can have an annual predictability. Obviously, we can't have a quarterly predictability. We all told you last time also. But on annually, if we can have it some good quarters and some not so good quarters. So quarter is not the metrics. Last 12 months could be the metrics. So that's what we are trying to look at it. And so we are preparing ourselves to meet that delay in the signature cycles.
So at least the decision-making cycle has not got more elongated, correct?
That's right. It's not more elongated, but it's remained 12 months.
It's as long. Got it. You've given us a rough revenue guidance. For Q3, I think you did close to 20% of margins, and you were indicating maybe sometime in FY26 you could get closer to around the mid-20s. The exit for FY26 should be around 25%?
Yeah, so I think that if you look at I will comment on business model. Our business model of product company is basically our cost. Last time also I spoken about the cost around 500 crore a quarter. That is not going to go up substantially because it's not service business. So any growth which is coming up is a profit accretive. So what you are estimating for the investor, they can calculate themselves. If I'm giving sustaining the same thing, that product business is not cost accretive, and our counterpart like FlexCube or Oracle financials, their margins in last 15 years grown up because of the non-linear cost increase. So that is where the trajectory over the next 4 years of Intellect will be visible to all of us.
Okay. All right, sir, good luck with all of those plans. And of course, we look forward to connecting with you. We'll do that shortly after the fourth quarter results are out. Thank you for joining us this morning. Okay, before we move on to our next discussion, just a quick glance at the market, and green is the color. Look at this. So all of the negativity which the market has sort of had to digest, Monday's global fall, that has been digested. The market's moved into positive territory. It's looking really good. And the mid-cap index is actually even better than the Nifty. The index there is gaining about 0.3%. So green for the time being. Let's now put the spotlight on the big news of the day. The government is all set to convert Vodafone Idea's outstanding spectrum dues into equity shares worth 36,950 crore rupees. This will mean that the government owns 49% of the company. To talk more about this development, we have with us Sanjay Kapoor, former CEO of Bharti Airtel, and Balaji Subramaniam, Vice President of IIFL Securities. Gentlemen, thank you so much for joining in. Mr. Kapoor, I'll start with you. I guess the second lifeline, right? And a lot of people would say they saw it coming because the AGR relief was struck down by the court. I mean, it was just not going through. Now, the question is, I mean, from a government's perspective, they will really want to see this cash work. The previous installment that came in, February 23, was the first infusion or the first conversion. That was about 16,000 crores. The government is already sitting on a loss on that investment. And now there is this one. What are the chances of success now that this overhang, at least the dues overhang, is out of the way for now?
So good morning to you and the viewers. Yes, of course, in the short run, if you see, it's clearly an indication both from the government and VIL that these efforts are towards business continuity and keeping it a going concern. That's what is exactly happening, and that is good for the customers in the market as well. But let me unfold and peel the onion a bit, because there are multiple stakeholders in what has happened. First, let me stick to VIL. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So, so they're not completely out of the woods. But from a business continuity perspective, a good sign in the short run. Now let's come to Indus Towers. Indus Towers, the second stakeholder in this, which I'm sure was getting discounted because of the uncertainty around Vodafone. And I think with this, probably the discounting might get reduced a wee bit at one end. But if they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel and Jio. They are stakeholders to this as well. Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies than a weaker VIL. For a simple reason, that a weaker VIL will resort to pricing and discounting, whereas a stronger VIL will not move towards discounting. They will compete more on improving their network and giving a better experience. Though, let's get down to the global scenario. In every single market of the world now, and I'm observing market after market, The third operator and the fourth operator is finding it very tough to survive for a simple reason that the capital cycles have shortened, and it is becoming very difficult for the third operator and fourth operator to be pumping in the same amount of capital as the first and the second operator. So markets are by and large moving towards duopolies in many parts of the world, on a pragmatic basis, on a profitability basis. And therefore, being a distant third operator will always keep that question mark to say, how long? Is this enough? Will there be another downfall? Will there be another uncertainty? So they're not completely out of the woods, but a welcome move.
That's an interesting observation, sir, on global markets as well, that globally the business is moving towards duopolies. But just to go back to that point, that, okay, this is, a reprieve at least. It's a lifeline, but it's just the first step. In terms of additional funding that VI will have to secure, debt funding, I don't know if there'll be equity funding. That's also a question, would you expect the promoters to also look at further equity infusion? They did one round last year. How much more money does VI need? They're losing subscribers. They have this AGR, due coming up in March, like you're saying. To what extent would they need additional funding, whether it's equity or debt?
Well, for the right reason, this is one industry which guzzles up a lot of capital. And with the capital cycles becoming shorter and the longevity of the technology reducing, capital is never going to go away. We are still pumping in money in 5G as VIL is catching up. The 6G will be around the corner before we realize that we've not even got the returns for 5G. AI is something everybody wants to invest behind, stay relevant to the market. So I guess the amount of money that they require right now, their cash flows are not going to be generating that much money to be pumped and take care of their capex. So they'll need to borrow money. Will the promoters put in money? I have my doubts, because they are, I think, reconciled now to the fact that they are happy to dilute, right? And they've gone below 26% now. And I don't think, as long as they're running the company, if it was to go down a wee bit further, I think they wouldn't mind that. But pumping in more money doesn't seem to be what I anticipate. I think they'll borrow money, and this might give them a little bit of headroom to go to the market and borrow some money.
Do you see them selling out? Is that a option at all? I know it's a completely wild question to even ask, but for the reasons that you mentioned, that you don't see them adding more money and adding more equity. Competition Commission of India concerns aside, that's a separate matter, but could we actually look at only two-horse race with this entity coming into either fold, Airtel or Jio?
Tough one according to me, because world over, the third and the fourth operators, given a choice, would find somebody at the right price and walk away. But that is not happening, because the investors are cautious that the third and the fourth operator, especially when they are distant third and fourth operator, are not easy to revive. On what basis? Because the top two operators are not going to relent at all. They're fully capitalized. They can borrow as much from the market. They can get more equity into the business. So they're not going to relent any space to the laggards anymore. So I think, given that scenario, where will an investor come who will invest in the third and the fourth operator?
Okay, all right, got that, sir. Well, let's get in Mr. Balaji as well into the conversation. Hi, Balaji, good morning. Thanks a lot for joining in. From an investor perspective, what do? There was that hope, right? Post the rights issue, there's something going to happen. They'll get that 11 rupees. They'll make big gains out there. Their fingers have got burnt. What do they do right now? Would you advise investors to hang on? There is a possibility that the Vodafone Idea, shareholders make money, or do you think that it's a sell and rise?
Morning. Thanks for having me on the show. So my view is that with the last weekend's development, the government is firmly behind the telco, and they're signaling that they would like to have a 3+1 market structure. So I think that Vodafone should continue as a going concern. They still have cash flow problems even after this equity conversion by the government, because this only takes care of spectrum dues for the next 2 odd years. They have the AGR dues, still, which they have to pay, which is around 16,500 crores, starting from 31st March of 2026. So they do have their cash flow constraints. So, my sense is that I wouldn't rule out further equity conversion by the government, maybe 18 to 24 months down the line. So that would mean that, even though Vodafone will continue as the third player, from an existing or a new shareholder standpoint, there is still meaningful dilution risk. So as you said, FPO happened, and one of the expectations was that there will be some relief on the AGR burden, but unfortunately the Supreme Court turned it down, and that is one part of the recovery plan that has not really worked out the way which Vodafone Idea and its stakeholders would have wanted to. So that remains an overhang.
So Balaji, you say that it can be good for customers because you'll have the other player that will function, but for a shareholder, maybe not.
Yeah, so I would believe that, for a customer, yes. From government receipts also, yes, the firm will continue. Especially for Indus, it's a positive because there is visibility on improved cash flows of Vodafone Idea and business continuity as well. So I think it is positive for Indus. I would probably prefer to play this development by buying Indus rather than Vodafone Idea itself. Of course, the stock, Vodafone Idea stock might, move up as it has moved up today based on these positive developments. But, fundamentally, as Sanjay was saying, the company is still not out of woods.
Your target price on Indus, Balaji? Today it's 357 CMP.
My target price is around 445. So that is, factoring in a successful debt raise completion by Vodafone Idea and, the CapEx program of 55,000 crores over FY25 to FY27 going as planned.
Okay, 55,000 crores of capex and huge debt raise ahead. Can they pull it off? Gentlemen, thank you so much for joining in and weighing in on big developments in the telecom space. Interesting. I don't know, to that point that they made, that maybe Balaji said that maybe there will be another round of this conversion from the government, but there will be a moral hazard to that as well, right? Would the government want this entity to become a PSU? Would it want to be holding on to a telecom company which is loss making? So I don't know. Political, moral.
Think BSNL, Surabhi.
Which is what I'm saying. So, do you really want to go back to the past?
Well, let's welcome in Mitesh now, who's with us with what he's making of things. Markets, of course, in focus. And it's, very, very sharp recovery from the lows. We were up about 30 points. We're down 40 now, 50, 23,472. So chopping around. Mitesh, your view on the price action so far is early, but what would you do?
Morning again, Prashant. I think it's very encouraging given the fact that we've immediately bounced back off from the gap down opening. And in fact, for a brief while, we did see the indices in green as well. So my sense is that it's okay. I think, we're basically holding on to the lower end of the range, and therefore in a day or two, a good chance that we will make an attempt towards the upper end of the range. On the stock side, Trent is a buy for me with a stop at 5,500 for targets of around 57.10, 57.20 on the upside. And the other one which I like, that's NMDC, which is a buy with a stop at 68 for targets of 72.
Okay. All right, Mitesh, thank you very much for that. We'll come back to you as the day progresses. Still some volatility on the screen because we turned positive. Now it's again about 50 points lower on the Nifty. Let's put the spotlight on a couple of stocks and news. Upasana, of course, is back with HAL. That stock's been holding up on a slightly weak day of trade because of the big order win. Upasana.
Well, Defence Ministry has signed 2 contracts with the company worth 62,700 crores. This contract is mainly for the supply of 156 light combat helicopters. Prachand, for Indian Army, it's 90 and 66 for Indian Air Force. Now, mind you, this is the single biggest procurement by Ministry of Defence from HAL till date is what the company has highlighted. And it has also reported its FY25 provisional revenue at 30,400 crore with a growth of just about 2% on a YoY basis. Now, if we look at the growth of FY24, it was double digit. It saw an uptick of 10% on YoY basis. And this year, the growth was lower. It is mainly due to the delay in the delivery timeline and also supply chain issues that were going on at the company. Now, company's order book stands strong at 1.84 lakh crores, and company says that it is gearing up for a robust FY26 with supply chain issues stabilizing, capacity enhancement, and also new order wins. So all in all, this stock remains in focus. And also UBS has given a buy rating on the stock and raised the target price to 5,440. It says that this award win, Prachand, is a positive surprise for the street, and LCA Mark 1/8 Aegis delivery is likely to drive P&L ramp up over the next 3 years, is what the brokerage has highlighted. So all in all, the stock remains in focus and we can see it surging in trade today.
Okay, all right, Upasana, thank you very much for that. That's Hindustan Aeronautics in focus today. Let's also talk about real estate companies, specifically the Maharashtra-based companies. Now, the state's ready reckoner rates have been hiked. Let's go across to Vinny to understand the math around this. Vinny, tell us, what does it mean?
Hi, good morning. So in terms of this rate increase that we're seeing from Maharashtra government for the state in terms of ready reckoner, on an average basis for the state, it is a 3.9% increase. Now, we're not seeing any rate change coming in the last 2 years. In the urban areas, this increases as much as 5.95%. Mumbai, specifically, we're seeing the ready reckoner rate increase by 3.4%. And obviously, for the Mumbai region, it's the lowest compared to other regions in the state of Maharashtra. Now, what does it mean? Higher ready reckoner rate means that we would see impact coming in terms of stamp duty, because everyone will have to pay higher stamp duty. So that increase in terms of prices on that front comes in. And, you know, it is not going to be easy to pass on this to the consumer from a developer's point of view, because the rates in Mumbai are already at a premium valuation in some parts of the city. So that is going to be something that we have to watch out from individual developers or individual companies as well. Higher stamp duty is something that we are watching out for now. So that is why a bit of a negative impact that has come in on Oberoi Realty, Godrej Properties, Macrotech developers, which are specifically, you know, have a higher portion in terms of their developments in the Mumbai region. Keep an eye out on this one. And obviously this rate change, we'll watch out for more clarity coming in from analysts, but some of them are highlighting that this is a negative, given that it's not going to be easy to pass on this increase.
Okay, all right. Thank you very much for that, Vinny. Appreciate it. We've got L&T, more orders coming their way, orders in the range of 2,500 to 5,000 crores for power transmission and distribution business. I mean, it's a bonanza. It has been a bonanza of orders, at least, for a lot of companies, L&T, HAL, and the like, largely in the industrials space. We'll take a quick commercial break here. We focus on commodities. Manisha will be here, and I suspect gold is in some focus. Stay with us.
Welcome back. Let's put the spotlight on the commodity markets now. We have Manisha joining in. So, Manisha, how are your markets gearing up for Liberation Day? April 2 is almost here. Well, I'm dressed in that color and my background is that color and it's unstoppable. That's the kind of rally that we've seen in case of gold. There's such strong safe haven buying coming in. If you look at the previous quarter, well, we've seen dollar index decline by more than 4% and you have seen gold prices gain up quite strongly. And you know, it's not just about US where we are trading at around 31.45 right now, but the gold prices have hit an all-time high in US, in India, in China, in Japan, Australia, Europe, and I could just about continue there because we're looking at very strong buying continuing here in various countries there. Well, the markets have seen very strong buying also when it comes to on a quarterly basis. It is all about concerns over the US reciprocal tariffs on April 2nd. The markets also seem to be believing that this is just the beginning, this is not the end, and you will see other countries retaliate and US again talking. So this is going to go on and gold will take support because of that. So after nearly 28% of gains in the previous year, you have seen gold prices gain up by 18% in the first quarter of 2025. And the way the all-time high that we are trading on today as well, it marks 20 days of all-time highs in 2025 till time. Well, the focus is going to be on tariffs going forward. And it also is about China, where many of the insurance industry is now coming in for gold. Remember, out of the 10 insurance companies, 4 insurance companies already have started allocating money in gold in the previous week itself. And that is the kind of gain that you're seeing because of that. Also, the kind of gold flows that we have seen in COMEX have surged, and these numbers will tell the story because in November 2024, it was at around 17 million ounces, and we're looking at nearly 43.3 million ounces on 31st of March. So that's the kind of run-up that we've seen in sense of US as well. Also, COMEX gold stock now equals nearly 5 years of US consumption, and the markets do believe that if the tariffs do not bother so much, then you will see this gold come back in case of UK and Europe, and the prices could see some profit taking. But at this point in time, the banks and brokerages do not believe that. If you look at Goldman Sachs, and that report really came in the previous week itself, they see 3,300 by the end of this year. But they also say that if the scenario is extreme, then you could be looking at gold prices going all the way to 4,500 also. Similar statement from Citi, 3,200 is base case and 3,500 in sense if the investment goes higher. You have Bank of America talking about higher prices in sense of gold. They're talking at about 3,350 in the next year. And then it is also about Bank of America suggesting that the prices will surge if only investment demand increases by 10% in the next 2 years or so. But ANZ, you have De Beers, Macquarie, UBS, those numbers should come in on your screens. And everybody is talking about further all-time highs. $3,200 to $3,500 an ounce by end of this year is what you can expect in sense of gold.
All right, Manisha, thank you very much. So absolute, ripper, 3.5%, 4% in the last 2 or 3 trading sessions, and continues to make all-time highs. We'll take a quick commercial break here. We come back and we will, as the quarter ends, as the financial year is ended and we enter the next one, we'll take stock as far as what the credit quality trends are looking like with CRISIL, CARE and ICRA. That conversation comes up in just a bit.
Welcome back. So let's talk about India Inc.'s health from a credit profile point of view. Now, according to ICRA, FY25 marked the fourth consecutive year of improving credit profiles. CareEdge says that these upgrades have been driven largely by strong domestic consumption as well as government spending. Meanwhile, CRISIL also remains quite positive on the credit outlook for FY26. So to talk about all of this, we have with us Somashekar Vemuri, Chief Criteria Officer and Senior Director at CRISIL Ratings, Sachin Gupta, Chief Ratings Officer at CareEdge Ratings, and we also have with us K. Ravichandran, Chief Ratings Officer at ICRA. Gentlemen, thank you very much for joining in. Somashekar, if I could start with you first, just tell us, what is expected, this improvement that we've seen in credit profiles all throughout FY25, do you expect it to last in the new financial year as well?
Thanks. Just to look at what has happened in the second half of last year, we had 423 rating upgrades and 160 rating downgrades, resulting in a credit ratio of 2.64 times. The upgrade rate was about 12.2%, downgrade rate was about 4.6%. And in terms of sectoral breakup, largely, you see the infra and infra-linked sectors turned out to be fairly buoyant and hence, contributed a lot of upgrades. On the other side, the export-oriented sectors such as specialty chemicals, agrochemicals, they saw a little bit of pressure. And going into fiscal 26, we continue the credit quality outlook also to be favorable, given that we expect a spur in the consumption demand on account of the announced budget tax breaks, the easing inflation, as well as the expected rate cuts. In addition, the continued thrust from the government side on infra spends will augur well for the infra and infra-linked sectors as well.
Gentlemen, morning. Thank you very much. Sachin, if you want to come in, what is your own kind of perspective? Domestic, yes, things perhaps may look a little better after the last 2-3 quarters of sluggish growth and earnings downgrades, etc. At least that's the hope. But suddenly the global environment is looking, a little dimmer. Over the weekend we had Goldman Sachs, which for the second time within a month has lowered their growth forecast for the US, and that's been the big growth driver. What is your sense, Sachin?
Yeah, thanks for having me. So if we see the last 6 months, there also the downgrades which have happened has been to a large extent for the sectors which are export dependent. Wherein there were pricing pressures because of Chinese dumping in a lot of markets, including India, and therefore the profit margins kind of got impacted. Now, what we fear is that we will see the more of the same in the coming year, especially because of the whole the tariff war which we are expecting to kind of blow up. We are all waiting for 2nd of April, that is tomorrow, to see what kind of tariffs, reciprocal tariffs are levied. But it is safe to assume that it will certainly have impact on certain sectors. Which sectors and how much is something that we will have to see. But the overall environment will be, very, very nervous. The growth also would be tepid. You're right. US is also looking at a, impact on the growth. So we in India, considering that we are largely, domestic and not so much external facing economy, the impact would be less. But nonetheless, there will be sectors and there will be companies which will get impacted on that count.
Okay. So, Sachin, do you want to expand on that point? Which sectors or segments do you think are at maximum risk for any possible deterioration on account of the global headwinds?
Yeah, so, if we were to just isolate the risk on account of the tariffs, now, well, we don't know what nature and form they will come in. But some of the sectors where India has a high share of exports, if you see the top 4 would be your textiles, your pharma, your gems and jewelry, and these would be the big ones, and electronics as well. Now, in the recent past, we've increased the share there. Now, there we believe more benign would be something like pharma, because that is non-discretionary and wherein India has a right to win because of the cost competitiveness. So there, if there are tariffs, most likely they will be passed on to the consumers in the US markets, and therefore there is not likely to be any impact on the demand per se. Whereas if I look at the complete opposite, will be say something like gems and jewelry, which is basically your cut and polished diamonds. There the impact could be slightly more, because if the tariffs are levied and if those are passed on to the consumers in US, as such, the demand has been a little weak. And in addition to that, if there is an increase in the cost of buying diamonds in US, that could also impact the demand. Similarly, on electronics, we believe while India has been increasing the share, but we may or may not really have a cost advantage as such, as compared to some Southeast Asian nations or China. So, it will be a play of discretionary spend versus India's cost advantage that will really decide. So we are also very, keenly watching how it really pans out.
Yeah, absolutely. A very, very uncertain environment. Let's also get to Mr. Ravichandran for his view. He's from ICRA. So what about you? So let's talk about the FY26 outlook. Which sector do you think could show the maximum improvement in credit profiles? I'm sure there will be a domestic-facing sector or segment. And like we were just asking Sachin, which external-facing sector is at maximum risk because of these global tariff issues that we're talking about?
Yeah, so with regard to the outlook for FY26, I would think consumption should come back, especially with this recent tax cut, that will come into being from the current financial year. And more importantly, we're expecting interest rate reductions in the current year, at least 50 to 75 basis points with the fall in the inflation. That should lead to lower mortgage rates, and that should lead to further pickup in consumption. And parallelly, RBI has done a lot of work with regard to easing the burden on the NBFCs, especially liquidity and reducing the risk weights on some of the unsecured loans and so on and so forth. All that should lead to lower cost of funding for the NBFCs, and overall availability of credit also should be going up. I would think one of the reasons for the slowdown in consumption has been the curbs on this lending. So with the better availability of credit, consumption should stage a comeback, the way I see it. Second lever would be, the continuing capex momentum from the government side as well as the private sector side. While private sector capex was subdued the last financial year, I would think that should come back in clean energy sectors, especially data centers and electric vehicles and renewable energy and so on and so forth. So overall, capex should also see good momentum. That should lead to better credit growth, and a better outlook for those sectors. Otherwise, with regard to the the sectors where one should be concerned, chemicals is one space where we are continuing to be cautious. While margin trajectory is improving, but still there are pricing pressures. To the extent one has to be watchful. In addition to that, we are quite concerned on the the power distribution per se. Overall, while there has been improvement in pricing discipline, payment track record has improved for the IPPs and other developers, but still we are concerned about the the cash losses being suffered by this discount. So that is another area we are watchful. Otherwise, a lot of investments are happening in the hope that eventually payment discipline will continue. That's the key thing to look at.
No, absolutely. And, these are important factors which we will have to look out for. Mr. Ravichandran, Sachin, Mr. Vemuri, thanks all of you for joining us. A shorter conversation today, but I hope you will join us again once we have more clarity on what comes our way in terms of tariffs, which I think is going to be the big talking point, one way or the other. By the way, the market has taken a dive and we are at fresh lows for the day. 23,325. The earlier gap down was 23,340, and now we have completely reversed, and how in a very, very dramatic kind of way. Market breadth is still positive. It was 4:1 in favor of advances. It is still very healthy, but about 2.5:1 in terms of advances to decline ratio, although that is also coming off a little bit. We will take a quick commercial break here. It's a wrap on Bazaar as well. Chartbusters is coming up, and that will take up all the action in just a bit.